Welcome, trader. It's Steven with TMT. No pain, all gain. Now let's trade some knowledge. Today we'll be answering the ultimate question. What is stock? This single question has haunted man since the beginning of time. That's because to really answer this one question, we must derive stock down to its core. Let's start by giving a basic definition of stock and shares. Stock, quite simply, resembles ownership of a company. Think of stock as a certificate, a piece of paper that credits you with ownership. Now stock, or ownership, can be divided into shares. This is just because companies can have more than one owner, so it makes sense to have the stock split. Now the more shares you own, the more of that company you own. Anyone that owns stock or shares in a company is referred to as a stockholder or shareholder. Now, do all companies have stock? The answer is yes. However, stock is handled differently in a private company than it is in a public company. In a private company, the stock is divided amongst its owners and is generally off limits to the public. Any purchase or sale of stock must be pre-approved by its existing shareholders. Now, for public companies, stock is made available to the public through brokerages and the stock market. If I wanted to buy the stock of a public company, I would just go to my broker and purchase a few shares. I wouldn't have to get the pre-approval from existing shareholders like I would in a private company. Now, you may be wondering how if anyone can buy the stock of a public company, then who really owns it? Recall that anyone who holds stock in a company, private or public, owns a portion of that company. Their proportion of ownership is equal to the proportion of shares they have compared to the total shares available. So, if someone has more than 50% of the company's shares, one could say that they own the company. Technically, we would refer to that person as the majority shareholder, since even a person with 1% of the shares still owns part of the company. One of the privileges of being a shareholder is that you have voting rights on major company matters. If you own stock in a company, you get a say. Public companies will mail surveys to their shareholders so they can vote on important decisions. That said, the weight of your vote is proportional to the number of shares you own. So ultimately, it will be the majority and significant minority shareholders that have the final say in major company decisions. Okay, now that we've got an idea of how stock and ownership are correlated, let's look at an analogy to get a better understanding of how a company's stock is valued and how that stock eventually gets issued to the public. It begins with pie. You heard it, fresh, delicious, hot pie. If we say the whole pie represents all the company's stock, then a slice of that pie would represent a share. Now we can slice that pie as many times as we want, but no matter how you split it, the total value remains the same. The same is true for stock. But this leads us to a number of questions. Like, who is the one actually splitting the stock up into shares? And how do they know how many shares to issue? And how is the price of one of the shares determined? Let's keep those questions in mind. However, we'll need to understand why companies issue stock in the first place. Companies issue stock to raise capital, also known as money. That capital can then be used by the company to make big purchases, expand its business, and become more profitable. The increased profits would then benefit both the company and its shareholders. But you may be asking, why can't the company just get a massive loan from the bank? That way, the company could get the capital it needs and without having to issue its stock to the public. It could then remain a private company and retain all the earnings for itself. Now, this is possible for some companies. However, the decision to lend money is the bank's call, so we should look at this from the bank's perspective. Lending money involves risk, specifically default risk. Banks prefer to lend money to companies that are well established and have a proven track record of stable and predictable earnings. This tells the bank that the company will likely be able to make interest payments on time and eventually pay off the loan all the way through maturity. However, this just isn't the case for most startup companies. Startups are typically in major debt, have small profit margins, and unpredictable fluctuations in revenue. All these things pose a major risk for lenders. Convincing a bank to lend you money when you have both a poor income statement and a poor balance sheet is wishful thinking. With limited options, these startup companies turn to the public and offer a stake in their company in return for capital. Now, interestingly enough, it's not the public the company will receive the money from, as going around the world to sell its stock would be ridiculous, not to mention unfair to potential investors because they wouldn't know what other people are paying for the company's stock. Instead, the company begins a process known as the initial public offering, or IPO for short. The IPO represents the process and transition of a company going from private to public. To start, the company must find an underwriter, which 9 times out of 10 is a bank. The company and the bank sit down and negotiate as to what the actual value of the company is. So going back to the pie example, how would you go about determining the value of that pie? Probably taste, ingredients, and size, right? So a similar approach is taken for companies, except that the value would be measured based on the company's earnings, assets and liabilities, cash flow, and overall size. Banks will also consider industry comparables, growth prospects, and the overall narrative of the company. Now let's assume the bank comes to a decision on the total value of the company. That value, less the share value the company decides to keep, is the share value that will be sold to the public and the proceeds the company will receive from the bank. The bank will also determine an appropriate price per share that will be attractive to the public when the shares are offered in the stock market. So now that the total value and the targeted price per share has been determined, the total number of shares can be calculated. These shares, less the shares that the company decided to keep, will then be distributed to brokers, advertised, and sold to the public in the stock market on the date of the IPO. And now the fun begins. On the day of the IPO, the once private company is now officially public, and its stock along with it. Investors and traders everywhere can now buy or sell its stock. The previous value of the company is no more, as now the value of the company is dependent on the supply and demand of its stock, where the supply is the fixed number of shares issued to the public, and the demand is the public's interest in purchasing shares at the current price. This new and ever-fluctuating value is most commonly referred to as market value or market capital. If there are more buyers than sellers at the current stock price, the stock price will rise. Or on the other hand, if there are more sellers than buyers, the stock price will fall. Now let's take a quick look at how traders can make money from these stock price fluctuations. Let's say you check the stock market and notice company XYZ shares are selling for $50. You decide to put an order into your broker to buy 10 shares. The broker fills your order and debits your account $500 to cover the cost of the 10 shares. You now own 10 shares of XYZ with a cost basis of $50 per share. A month later, you check the stock market and notice that XYZ shares are now selling for $100. You decide to sell your 10 shares at that price. Doing so, you receive a total of $1,000. You just made $500. But even more importantly, your investment returned 100% in just a month. Now, why is measuring performance in percent gain and not capital gain so important? Here's why. Let's say there are two traders, Joe and Schmo. Joe invests $50 in stock X. Schmo invests $1,000 in stock Y. After a month, they both sell their stock. Joe ends up making $50 and Schmo makes $250. Now, which trader performed better? Joe, since his stock had to return 100% on his $50 investment just to make $50, whereas Schmo's stock returned 25% on his investment to make $250. It's for this reason that having little capital to trade can be discouraging for new traders, because a 100% gain on $50 just doesn't have the same impact as a 100% gain on, let's say, $50,000. However, don't be deterred. With a profitable trading system, a small amount of capital can go a long way, and with TMT's help, you'll be there in no time. You're officially one step closer to becoming the modern trader.